Good evening, everyone. Please let me know if I'm audible as well as clearly visible. I hope your AFM examination went well. And today we are starting with our specific particular examination is for 55 or 60 marks. No, not like that. This is asked for maybe around 45 to 50 marks, and then this would be for the next 50 to 55 marks. That is the basic difference that happens. But overall, when we talk about this examination, a part of it is pure theory, that is A plus D. If you focus on this part more, okay, so out of this 50 marks we can expect at least 35 to 40 marks from this area because of accuracy and everything else. If I talk about being a human, there two air is human, so 40 15 15 10 to 15 marks is something you should definitely keep. This might go wrong in the examination, so 35 to 40 marks if you score from here and you focus on B and C on specific chapters. If I tell you that these are slightly more important than others and you focus on those chapters properly, what can happen is you can add at least 30 more. Okay, so if you can go up to this 65 to 70 marks in this area, that means BFM, where you might be having lesser marks, can be set off with BRBL as well as ABFM. But for that, you have to work harder on both the A plus D as well as B plus C selected chapters. More important, a few chapters which are less important as well. I'm starting with one of the most important chapters today, that is sources of finance and financial strategies. Probably we'll be covering at least 1.5 or 2 chapters today. Second chapter that we'll be looking forward to is leverages. Again, a very important chapter which is frequently asked in the examination. Okay, so everybody, so we'll be talking about all those important areas, and already I have discussed the case studies of module B altogether, and we were discussing module C case studies in the previous class. So I'll be continuing with that part in the class itself, in the content area. Okay. Done. So let's proceed further and talk about sources of finance. Everybody who's there on YouTube, if you haven't enrolled in our course yet, you should definitely look forward to it. And don't forget to use the code Y541 at this point of time. Our course are available at 80% discount. So you can use the code Y541 to get 80% discount plus 1% extra is available. Okay? Chali everyone, let's begin with the session. When we talk about the specific area of business finance, you'll get all this theoretical part for you, right? So I'll give you this theory part. I'll be talking about the most important area. I've given you it in the summarized way. This is from the Macmillan book itself. That means if you haven't read the book there, or you have taken only the classes, or you have gone through the syllabus even, this will be helpful for you. And you can download the particular PDF of this particular session as well. Okay? So once you get the particular session there, you can download it, and in this particular PDF, you'll also find the MCQs that I'm discussing with you as well. Rest, the sessions that we are having on YouTube, those are also available for you. So let's proceed further, everyone. Okay, first of all, when we talk about the business finance, what do you mean by business finance? First module is all about management. Second is about financial management. How do you manage your finances? When we talk about finances, the first part is your business finance, the money that you use in your business. In this area, the first part is bridge finance, right? There is certain part which is called business finance. Business finance, matlab the money that you need in your business. It can be yours, which is equity. It can be something which you are asking from other one, the people, that is your debt, and a few people, that is another class which has a few characteristics of equity, a few characteristics of debt, that is your preference shares, right? So these are the three major sources of finance. Along with this, there is something called this bridge finance. What do you mean by the bridge, everyone? I am standing at this position. I want to reach this position. To reach these positions, can I see that I have to cross through this difference? If I have to cross this particular area, during this crossing part, I need to have funding. I need to have funds during this crossing part. This is called bridge financing. ठीक है. That means when you are a local company and you decide to go national, that means you are enrolled in SEBI or get listed under SEBI and getting shares from the people. At that point of time, before you head towards getting money from people, you have to wait for certain time now. So that particular certain time where you have to run your large scale business with your own funding is not possible. So what will you do? You will take the minor loans from the bank, small loans, which can help you to sustain till the time you don't get bigger funding. That is called bridge finance. So this is basically, it's a temporary funding which helps you to bridge the gap between where you are and where you want to be, where you get the long term money and currently you are having lesser money. Then they'll be also talking about working capital finance. Day to day basis we need money, that is also a part of our business. So we need money not only to buy big assets or to run our business, but to give salaries to people, but to maintain our business, but to run the basic functionality of everyday basis. That is working capital finance. In this area, this is one particular which is called clean finance versus borrowing. Clean finance means your equity, everyone. Equity is quite expensive by everyone. Equity means ownership. If you ask someone to be an owner of the organization just like you are giving your voting powers. But always remember, the one who has the voting powers, he lives on leftovers. When the company makes huge amount of money, they will get huge amount of money. But when the company is dying, at that point of time, they are also doomed to die. This won't happen, that the organization will not be growing further from this point of view. ठीक है ना? So basically what happens is, equity shareholder will not only share money or the leftover, but will also share the risk with you. If he is getting voting power with you, he will also share risk with you. Done, everyone? Chaliye. Now, based upon this, what do we have? We have something called borrowings. Now, equity is basically the one who is getting voting powers. So obviously, if he's getting voting powers, they are too expensive for us. When the company will start making more money, no matter for what reason, we took a loan, we started earning more. He will be like, "Acha, you took a loan and started earning more." Then even the good part is that even if you are making money from loans, you took a major loan, the project went good, and you started making a huge amount of money, then even this huge amount of money that you are earning, this will also be shared with equity shareholder. Matlab, everyone, however the company grows, equity shareholder will always ask for more money. Your lenders can never do that. If you took a loan for 10 lakh rupees, okay, and your company started growing at a major level, then there is no fight. The lender will get interest, he will get principal, and this is it. This is the end of the story. There is nothing else that will happen, right? That is the difference between equity and the borrowings. These are outsiders. Outsiders can never ask for anything. They will get fixed and fixed interest, as well as the EMI that they will be getting back. So basically, these are outsiders funds, and clean finance is your insider funds or the owner funds. Equity capital is the owner funding that we talk about. This is the initial investment, and obviously a part of it is retained in the business and a part is given to the owners as a reward. You are the risk taker, so every single year a chunk of profit is paid in the form of dividend, and a part of it is retained in the business, which is called reserves and surplus. In our book, they have written it as internal accrual. Okay? So internal accrual is the money that we are having in the business. We are saving it for our future. Okay? So that is how we define the term internal accrual. When we talk about the equity capital, equity is basically you take up 1 lakh rupees and you say the overall number of units is 10,000. So value of each unit is what, everyone? Value of we have got 10,000 equity shares at the rate of rupees 10 each. That's how we define equity shares, and this is their nominal value. Nominal value means book value. In this case, if you are the owner of the organization, you have the right to receive dividend. You also have surplus, the surplus which is collected together, that is also your money. If even if it stays in the business, you get voting. Okay, there is something called differential voting rights as well. Differential voting right means it is your choice. You don't want to go for voting, but you want good returns, then you can give away your voting right. Okay, partially you can reduce your voting. Then in this case, but always remember, when the company dies, equity shareholder will almost get nothing, because everybody else will get the money back, and then equity shareholder would be waiting for the remaining chotu motu funding, whatever is left. That is the problem with equity shares. So equity shareholding means the company, this is the soul of the company. Till the time the company is alive, the money that equity shareholder has given, this money will stay in the business no matter what. Okay, so in this case, that's one part. Then liquidity for listed companies through stock exchange. Public companies are making money by putting themselves on SEBI. SEBI listing is there. You put yourself into the market and people invest their funds into your company. Flexibility in pricing, increasing, reducing, or buying back shares. What you can do is, if you want that, you want to get, you don't want to control your voting rights. You don't want many people to be a part of it. For example, there were five shareholders: A, B, C, D, and E. This company can ask E to sell their shares back to them. This is called buyback. The company can change their pricing of per share from 10 to 20, 20, 30. This can also happen by clubbing multiple shares. You can increase the price, you can reduce the price, because it is owned by the company. And ability to pledge the shares, it's one of the most important securities of the organization. So it can be given as a security when you borrow any funds. Okay, that's equity share capital, everyone. In terms of equity share capital, what happens is we have different types of shares. What types of shares exists? Number one is authorized. I went to see the Companies Act 2013. Okay, I went to Companies Act 2013. This is covered by Ministry of Corporate Affairs. Ministry of Corporate Affairs said that you want to open up a company. मैंने कहा हाँ जी. So in this case, they said that if you want to open up a company, then what will happen? In this case, the first thing that you have to do is you need to have authorized capital. Authorized capital means you have to take permission from Ministry of Corporate Affairs that, sir, I want to start a company with 10 lakh rupees. You took the maximum money that you can raise right now is 10 lakh. This is the maximum money that you can raise, and this is written in your memorandum and articles of association. Memorandum of association is your dealing with the outside world, written in the form of policies and dealings in a detailed manner. Article of association is your dealing with internal people, employees and all, right? Employees, the directors, and everybody else. The details of it is written in article of association, basically policy books of the companies. Then this is the maximum permission that I've taken, and I don't exploit the entire permission. For example, my mom said, Niharika, you have to be back by 10 p.m. I don't exploit this position. I tell everybody I have to be home by 8 p.m. My choice, right? So what I can do is, if the company has taken 10 lakh rupees as authorized capital, maximum they can raise, they issue 2 lakh rupees to people. They ask people that we are offering 2 lakh rupees as capital. Are you interested in becoming shareholders of the company? If they come up, they subscribe. For example, if you take Netflix subscription, that means you have taken the subscription. You are taking the those particular things. That means you have to pay for that. If you subscribe things, you have to pay, which is called paid up share capital. Okay, paid up share capital. Acha, in case someone doesn't pay, that is called calls in arrears. There are people who take up the shares but they do not pay the entire amount. That's called calls in arrears. Though it does not exist right now, it used to exist earlier, but we still study this point. If a person pays, it's called paid up capital. If he doesn't pay, it's called calls in arrears. And if someone pays before time, simple, it is called calls in advance. Okay? Not only this, everyone, after this, if, for example, Mr. X took up the share for rupees 10, he paid rupees 6. This is his paid up amount. And after this, he said that I cannot pay the remaining amount. I said, why can't you pay the remaining amount? He said, I do not wish to be a part of this company anymore. And what happened is, after this, he did not respond. So 6 was paid up and 4 was arrears. Okay. So after a certain period of time, I kept on calling him, sir, your amount is pending, your amount is pending. He didn't show up. So that means now his share of rupees 10 is now cancelled. He is no more a shareholder of the company. And whatever money he has already paid, we will not return it. It is his mistake. He subscribed the share and then he didn't pay. So this is basically something that they will define as this is something that the money, the paid up funds that we have got, but we are not going to give it to anyone. This is forfeiture. Forfeiture matlab the part of the paid up capital which we will not return to the person just because he didn't pay the remaining amount. So we have to give them the lesson that in our organization nobody can have a fault. Okay? You cannot do this with the company that you agreed to get the shares and then they didn't take up that part. Lingaraju sir, is it visible right now? I think it is visible to me overall. If it is visible to everyone else, please let me know. Everybody in the paid portal as well, is there any issue with the particular area? Or are you able to see this area properly? If you're facing any problem, then I can increase the size of the specific data as well. Talking about what are the advantages of having equity shares. Equity means you are being the owner. So if you are becoming the owner, the first and most important thing is you do not see, owner will never be required to pay a certain amount of money for pakka mode. So there is no mandatory interest or compensation. At the same time, there is no repayment requirement. This is the certain amount of money that you have to pay. There is no sort of that. Why? Because these people are taking the risk. They are the owners of the organization now. If they are the owners of the organization, they cannot crib about it at all. So in this case, there is no repayment required. Then provides risk capital. These people are providing the funding to the organization without thinking ki pata nahi they will get anything in return or not. But they are giving these funds to these organizations. And if you are doing all this, you become the owner. So this instills the ownership and it increases lender confidence. Lender becomes very happy because he thinks that this company has got a lot of funding from the owner itself. That means we would be paid off in any case. Okay? Then disadvantages. Everyone, this is a risky capital. So there is higher cost. The person will always ask for higher returns as well. Costlier to raise. You try to raise funds from people. The share market is not easy to reach out to. It is very difficult to reach out to the share market. That means raising funds is very difficult. And higher actual cost of servicing due to post-tax dividend payment. There would be more actual cost than potential delusion of control. Basically, if I am an owner, while earlier we were 3 people, let's say A, B, and C. We were 3 people who were a part of this organization. Now, if we add D as an equity shareholder, if he becomes an equity shareholder, our control, it is being diluted. which is not good for the organization, right? Because then everything has to be asked to that particular person as well. So this will make our working more difficult than easy. That is a part of equity share capital. Then comes internal accrual. Everyone, this is the savings of the organization which is existing in the business, and this money is something that will exist in the business, and we will try to use these savings as and when they are required. So basically, one part is definitely there, since this is savings of the money which were supposed to be given to the equity shareholders. What will happen? There is no restriction on use. This is your saving. Whatever you want to do with it. Readily available. Obviously, this is your funding, so you can pick it up and use it as and when and the way you want it. Okay. Then comes, there is no cost of using or servicing. If I take a loan, there is a cost. If I issue more equity shares, there is a cost. But using my own saved funding will never have a cost. You know? But the truth is, since this is the funding of the equity shareholder, for example, if I pay equity shareholder 10% and on an annual basis, this is the remaining portion which is not paid to them. So ideally, once the organization is paying anything to anybody else through internal accruals cost is same as cost of equity, because this is the fund of your equity shareholder which he did not distribute. Then comes, there is no impact on ownership structure. There is no impact because you are saving your money and using it. So there will never be a fight against it. Then next part is disadvantages. What are the disadvantages of this, everyone? One of the major disadvantages of this would be that the cost is higher. See, the major problem is that this is your saving. If you do not wish to use your saving properly, you can use it for fraudulent purposes. You can have higher actual cost due to undeclared dividends. Your dividends can be undeclared. You can try to take away the fund of the owners and try to save it for yourself. Or you can just give a lot of savings to anybody without checking it out. So this can actually reduce safety of the company as well, because these savings are basically something which acts as a security of the organization. Now, that even if the company is dying, at least this funding is definitely there with them. Done, everybody? Then comes internal accrual over. Now, there is another important classification which is called preference share capital, everyone. How do we define preference share capital? Let's talk about this part. Pata hai, equity shareholder is the true owner of the organization. They have high risk and they get good rewards. These people say that I want to be the owner, but I do not want to have greater risk. I want to have lower risk. So they are also owners who deny that they want to share a lot of risk. How do they reduce their risk, everyone? They tell the company that before you pay even a single penny to equity, pay us before them. Matlab, first of all, pay dividend to us before equity, that too at a fixed dividend rate. Matlab, define a dividend rate, 10%, 15%, and pay me accordingly. And at the same time, whenever you are paying us, there should not be anything where whenever the company is dying, even at that point of time, you are supposed to pay me before. That means when the company is liquidating at that point of time, as well as when the company is paying a single penny to equity, these people will stand first and get their funding first. Then non-obligatory dividend distribution. There's one more point. No profit, no dividend. There is, since they are also trying to be the owners of the company, if the company makes money, they are due for money. If the company doesn't make money, there is no fight to give them money. Then always remember, there are certain kind of preference shares which are called cumulative and non-cumulative, everyone. Dividend was supposed to be given in D1, second year, third year, fourth year. Okay? They gave dividend in the first year and second year. Third year they missed. Gave it in the fourth year and only the fourth year dividend. That means you lost the dividend for third year, This is called non-accumulative, something which does not accumulate. The dividend that you lose just because you the in that particular year the company could not pay. Okay. In cumulative there is an accumulation means if we are supposed to give funding, then if we pay dividend for the first year, if we pay dividend for the second year, then if we missed it out in the third year, in the fourth year you have to pay both the dividends, D3 plus D4 both together. Next is redeemable within a specified period. The preference shares are not like equity. Equity shareholders is the spirit of the organization. If you do not wish to pay them, then what will happen? The company will die. These people are the true spirits of the organization. Preference share isn't. So if you raise funding from preference shareholder, then what will happen? You have to pay them back within a period of 20 years, because these are kind of lenders. Owner is equity, rest everybody is a lender. So preference shareholder is basically a person who gave money to the company and within the next 20 years you have to pay them back. It is called redeemable preference shares. In our country, we are not allowed to issue irredeemable preference shares. The preference shares, you have given money, till the time the company doesn't die, your money remains there. That is called irredeemable. Equity shares are always like that, but preference aren't issued that way in our country specifically. And these people do not have voting rights. Their voting right arises only when the company fails to pay dividend for continuously 2 years. Done, everyone? Everybody sorted? They have voting rights, but very limited voting rights. Only they will get, normally they do not have any voting rights. They will get the voting rights at only one situation, and the situation is when the company fails to pay dividend for 2 continuous years. Only then these people will get dividend. Otherwise, they will have voting rights. Otherwise, they do not have any voting rights at all. The voting rights are exclusively given only to equity shareholders. Okay, so company can raise funds from these, and it's good even you are not giving your complete ownership to these people, and these people are basically someone who are a part of your organization as an owner, that too for a long term basis. Huh? And if your company doesn't make good money, then you don't even have to pay. That's a good part about the preference shares. So in this case, the cost of fundraising is not that much because you don't give up on your ownership. Maintaining control over management, your management control is maintained, and even the drawbacks include potential management. Okay, your drawbacks are basically there's one problem: these people will never be a part of your management. They don't have any voting rights at all, and we have to pay them dividends to keep them happy, though. You know. Next part. Got the idea, everyone? Let's talk about the next part now. Equity shareholding done, preference done. Acha, there is one more pointer. In our country, if you issue preference shares, then within a period of 20 years, you have to pay them back. In case of infrastructure companies, you can have it for more than 20 years, but only and only in case of infrastructure companies. Nobody else is allowed to issue preference shares for more than 20 years. Okay? Rest everybody has to pay it before 20 years have passed from the date of issue. Then comes term loans, everyone. Term loans are long-term loans that we take and then we pay off. You know? So if we take these loans, there are different types of loans. 0 to 1 year is short term. Then 1 to 5 year is medium term, and 5 above is basically your long term. Okay? When we have long term loans, there's a lot of funding from other people. So that means this is a charge. You will have to pay the money no matter whether you earn income or not. In terms of dividends, you don't have to worry. right? Equity in preference, you don't have to worry. If you don't make money, you don't pay. But in terms of term loan, whether you make money or not, the loan has to be repaid. So this is used for acquiring the tangible assets. You buy plant and machinery, you buy land by you having term loans. And then there is a specified rate of interest as well, and you repay in installments, EMIs based upon this. And you look at all these loans only when you see a viability of that particular project. If you raise funds from that project, it would be helpful. Only then you will do it, right? Then everybody got the idea? This is based upon what? Appraisal based on project viability. If the project is good, you will raise funds from this. Otherwise, you will not. What is it that we have to worry about in terms of term loans? First of all, board reconstitution. See, if I take a term loan now, those people will put restrictions on me on how to use the money. They can also appoint independent directors to see whether I'm using their funding properly or not. Lenders' consent has to be taken whenever we are doing something big with our business. We have to ensure that the company is not dying. Restrictions on dividend payout and further borrowing. The problem is if you take loans from someone, they will always have a control over that part of fund, right? So in this case, they can create a lot of interference in your company. Regular financial reporting has to be given. Then comes maintenance of prudent financial ratios. You have to maintain debt equity ratio, debt service coverage ratio. These are something which are super important that you have to maintain no matter how things goes. And strong corporate governance practices. You have to follow that. When we talk about the companies, these are run by people, but to maintain their particular working in a peaceful way, they have to follow the company rules. Done. So due to these limitations, I think term loans are not taken that much because you are scared कि अरे if I take a particular loan, EMI has to be paid, interest has to be paid. But there is one more good point as well. Now you don't give up on your voting rights, है ना? Then comes debentures. Term loan is something that you take from banks. Debentures is something which you raise your funding from general public. You literally go out to the general public and say that this is our company and this is where we would like to raise funding through loans. So the people will invest their funding and give it to that particular person, and then once the companies are throwing, they will start making a repayment. So in this case, debentures means the money that you borrow from general public. ठीक है ना? In this case, it's a debt instrument which is in the written form, and in this case, you also have to pay a certain amount of money, and that too there's a fixity of interest as well. Whatever interest that you have to pay, there is a fixity to it. मतलब the interest that you have to pay, the interest has to be paid no matter how you look at it. ठीक है? This is actually a debt instrument. You take a loan and then you pay accordingly. There's a fixed amount, and when the loans are huge, then the company can also face problems with trustees. These trustees may be appointed just to see the funding that you have generated. Are you using it properly or not? Then these people do not have any voting rights. Of course, they can never have. And then potential for convertibility to equity. Done, everybody? This is where we have talked about the debentures. Now, in terms of debentures, if I am the owner of the organization, if I want to be the owner, then what I can do is I gave a loan to the company. Then I can say that convert this loan into ownership right. Matlab, loan can be converted into equity, which is called convertible debentures. The debentures where you are having security there, then that is covered there. Abdullah sir, visible na? Chaliye, good to know. Everybody, that means if you have loans, then loans can be converted into what? Those loans can be converted into capital. That means a debenture holder can be converted into equity. That is called convertible debentures. Earlier, there used to be only convertible debentures. Now it is the option of the investor whether he is investing funds and getting interest, or he wants to become now an equity shareholder. Next important point is options for call and put features. Call feature is where company can ask people कि देखिए we have got money, can we take it, can we pay you off? We are asking the particular investor कि sir, here's the money, take it and go. That is the company's call. And put feature is where investor can go to the company and say, where is my money? Give me my money back. That is put feature. Call feature is where company stands up, and put feature is where the person stands up. Okay? So debentures can be based upon long term, short term, medium term, and then there can be the debentures which are paid at once, or the ones which will not be repaid at once. They would be repaid over the period of time. Tenure is one part, security is another part. What are you giving as a security will determine the specific value further. ठीक है ना? Then there is convertibility, and then is negotiability. See, convertibility means whatever you look forward to it, what are the repercussions of it. And then we have the interests paid, whatever interest that we have to pay, all those things, that is a part of your loans. Done, everybody? This is a part of your debentures. Then we have the specific area of alternative financing strategies. This means we are done with the primitive methods, equity, debt, and preference. They said there are other methods as well. For example, small and medium enterprises, they can take up all these loans. Startups and even real estate, they are also looking forward to it. First is modern financial center. First is peer-to-peer lending. A wanted money from B, B helped A. Okay? This is how we define peer-to-peer lending. Done, everyone? So this is one thing that can be there. Startups is basically what? When you start your own organization, that is called startup. Obviously, these organizations are always under threat. You never know. Done, everybody? Now, in terms of alternate financing strategies, what are the different ways through which you can raise your funds? First is peer-to-peer, one particular person giving it to another. Crowdfunding, when you raise your funds from general public and then you can start your business. This is not very popular in India, but very popular in US. Then they have alternate finance funds. These are a part of it. Then mutual funds. But under mutual funds, what happens if I put 1,000 rupees in the mutual funds? That 1,000 rupees would be split among 1 rupee, 2 rupee, 3 rupee, 100 rupees among various companies. And this money would be spent there. You will buy the specific shares of that company. And then once you come back, you are holding mutual funds. The funds in which your risk has been segregated. Then we have sector specific options. We have to look forward to it. We're looking at education sector, production sector, then the pharmacy sector. There are different sectors in the specific fields altogether. So we have to make sure that the specific yield gets enough in terms of the working. So self-financing is basically looking forward towards your money and putting it in your pockets itself. That means bootstrapping. You are using your money to start your own organization. Okay? That is how we define the area of self-financing, and even in terms of sector specific. Then everyone got the idea of self-financing? The funding that the owner provides, it is also called bootstrapping. Done, everybody? This is called self financing. You can also raise your funds through real estate as well. Real estate, you can put your money now. Real estate is growing like anything. Infrastructure, you're putting money into different businesses altogether so that the growth can be there. This is another important area. Then private equity. Private equity is what, Pata? See, there is a particular company which I saw has a lot of potential. I was like, this company has got a lot of potential, everyone. So, what do we do about this company? They say that if this company has a lot of potential, then why don't we put money into this organization? So basically what happens is, in terms of private equity, there are certain people who saw that specific spark in this organization and made sure that the specific business is also bought by them. In terms of private equity, that means there is no government money. Done, everybody? Private equity means the bestie that you have made. So basically what happens is, if I have a company, okay, I have a company A, and I want Mr. B to put money into my company. So he gives money because he sees an already established and a good company. So this is where private equity enters. This is often called patient capital. The company saw that your company is growing, so they invested good money into your organization based upon your growth potential. So in this case, what do? They can, or organizations can get funding at multiple levels. First is when they start a business, seed financing. I had an idea. I would like to start a garment business. That is my seed idea. So I'll generate funds for that. Startup, once you start with your commercialization of working, then you need funding. Then the first stage, which is based upon commercialization. Second is once you have commercialized and you want growth, and then you want stability in terms of third stage. So basically, this is how you start your businesses. Then, whenever you want to reach out to the share market at any point of time, then you also need to go for bridge financing. Why? Because you are going big in the market, and right now you are standing here. The difference between these two is major. But during the period that you will generate major funds, you will have to wait now. That is called bridge financing. Then comes leveraged buyout. I thought I would like to buy, I am company A and I wanted to buy company B. I do not have much money. So what will I do? I will borrow money. Okay? I will borrow money from Mr. Y just to gain funds, and then I will buy you. Why, everyone? Why do we do this? So that we can eradicate our competitors. Okay? When you take a loan and then you pay off the specific amounts, it is called a leveraged buyout. Next part is management buyout. MBO matlab, instead of buying the entire company, all those assets, you buy all the brains of the organization. That's called management buyout. Done, everybody? This is called MBO, management buyouts. Either you buy the entire organization by taking a loan, leveraged, or you buy the entire management. If the management, the brain of the organization is in your hands, you are in a win-win situation. This is where all these things are given in detail. Huh? Startup, seed, first, second, third. See, there is one more point which we are supposed to discuss, that is called PIPE, private investment in public equity. basically what you see is you are an organization which is there in the market in a detailed way. You work in the market, you are growing in the market, and what happens is then this particular company wants growth. So how do they make sure that they are having growth? These people, they look forward towards a specific area of a bigger organization growing through this. This is basically private investment in a public equity. Matlab there is a public company. In this case, you introduce the money privately instead of having it publicly. While the public companies are supposed to be very transparent, है ना? So in this case, these people are asked that we want you to be a part of the company. Maybe because they are a better guide towards the company, or maybe those people are very good employees that can work with you. So all those things can happen. So private investment in public sector, matlab it's a public sector company where everybody is equal, but then they decide to have one particular shareholder which has a huge amount of money, and you enter them through the private treatment. ठीक है, all these things are covered. Leveraged buyout, management buyout, all these things are given. This was given by Pratt in 1981. This can be asked in the examination. ठीक है, what is this particular sequence in terms of types of private equity? Any doubts in this area, everyone? Otherwise, we are almost done with this chapter. But before I end this chapter, everybody who's there on the YouTube, if you are planning to purchase our course, and this is what we'll be covering in our courses there. So if you are planning, then please check out our website. Let me show you. Everybody, this is our website, www.adda247.com. Everybody on YouTube or anywhere else you are looking at our courses, then you can purchase the specific course that we are dealing with. The entire week we'll be dealing with the entire syllabus in this way, right, in the revision format. So what you can do is you can take up our revision batch here. Okay, so revision batch is available on our website. So if you're planning, then what you can do is use the code Y541 and get these things. And anybody who's planning it for the next year, this is for June 2025. If you're planning it for current situation, that means November 2024, this is where our Powerpack revision batch is. All you need to do is click on the area of buy now, use the code Y541 and apply it. You will get for 2799.20. So 2800 rupees, and you will get this specific course altogether, everyone. So everybody on YouTube, if you are planning to purchase our course, then do it right away. And don't forget to use the code Y541, as you will get it for a good part of it would be available as a discount. So everybody signing off from the YouTube. Thank you so much for being there. Everybody in the paid class, we are going to continue the class, so please be there. And everybody on the YouTube, all the very best for your examination as well. And if you are looking forward towards our classes, then join it right away. Don't forget to use the code Y541.